Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another Your Tax-Free Life podcast. This is actually episode number 91, so we've been doing this for quite some time now, and we're excited. We're fast approaching number 100, so I'm going to have something very special for you at that point in time. But today's episode is also going to be a very special one. I did a seminar last week at FIU, which is Florida International University, and it's a retirement workshop that I do every single month at the university, in which we're trying to educate people that are either closer to retirement or in retirement about the benefits of understanding tax planning, retirement distribution planning, how to manage risk in retirement, and so forth. So it's a very well put together workshop that I've been doing for quite some time. And then obviously we've been getting some questions and feedback at these workshops, and that's why I came up with a title for this workshop today. The title for this podcast today is To Roth or Not to Roth? Tax is the question. So this is one of the topics we discuss quite heavily all throughout the podcast we do here on a weekly basis, but also at the workshops, and then obviously whenever I do any type of audit, tax audit for any of the clients that I engage on a weekly basis and throughout the year. So I want to start by a quote that was done by President Ronald Reagan, the 40th President of the United States many years ago. And he basically said, and I quote, the problem with our tax system is not that Americans pay too little. The problem with our tax system is that government spends too much. And I think we can all agree on the fact that the vast majority of Americans understand that our government spends a tremendous amount of money. Actually, according to all the numbers that I read and the statistics and all the governmental reports that come out on a regular basis, the government is actually spending money that they don't have. So that's one of the major premises. And by the way, when President Ronald Reagan made that comment and that statement over 40 years ago, it was as true then as it is today. Another email that I've been getting, and I've gotten several of those over the last 2 weeks from some of you, is, what is it, some of the things that I do from an audit perspective, because some of you may very well be interested in reaching out. And always remember that you can always reach out to me for any questions that you may have regarding the podcast that we're covering at no cost or obligation to you. So rest assured that I'm not going to be asking for money whenever you're reaching out or sending me an email with a question that you have. But just to clarify some of the things that we do here at Gables in Cambridge as well, we do three things, and we do them very well. We do tax planning, we do insurance planning, and retirement planning. On the tax planning side of the house, we do accounting, bookkeeping, payroll services, and most important, we do tax planning and tax planning retirement blueprints, and that's something that we're very, very well known for. On the insurance side of the house, we do 7702 planning, which you'll hear a little bit more. And obviously, you have heard me talk about 7702 plans in other podcasts. Long-term care planning, business services. We do a lot of business with small business owners throughout the United States. We do some estate planning, and then obviously Social Security and Medicare planning. On the retirement side of the house, life settlements is one of the major areas that we spend time on. Obviously, they have to be approved investors in order to be able to invest in life settlement programs. We also do principal protection planning because it is one of the most critical aspects of retirement distribution planning, is to make certain that you don't run out of income before you run out of life. And then last but not least, we also do some pension planning. So, but once again, that's all I wanted to say about what we do. For those of you that may be interested in reaching out to us and reaching out to me, in order to engage us a little further, then obviously I'll go into a little bit more details at that point in time. Now, as you have heard me say many a times, what is the goal of a mountain climber? And what I hear from the vast majority of the clients and the vast majority of the workshops, like the ones that I did last week at Florida International University, which is FIU for short, is that the goal of a mountain climber is to get to the top of the mountain. And I would argue that's only half of the goal. It's just like if you're watching a football game. Does anybody really care what the score of the game is at halftime? There's only one score that really matters, and that's at the end of the game. Well, the same thing applies for mountain climbing. Getting to the top of the mountain is, or getting to the summit, is not necessarily the goal. The goal is to make it all the way to the summit, but then to also make it safely all the way down in order to be able to tell the story. Now, when I try to make analogies between climbing a mountain and retirement planning, I look at it from two perspectives. As you're climbing the mountain, you are on the accumulation side of the mountain. So you're putting money away on a regular basis. You're trying to get the highest rate of return possible. You're trying to minimize your tax liabilities and so forth. But then once you get to the summit and of retirement, which would be your retirement age, depending on what year you want to retire and what age you want to retire. When you start to come down the other side of the mountain, now you're in the distribution stage of retirement. And there's a major difference, and most of us need to be able to do a paradigm shift between accumulation and distribution, because the rules of engagement totally change. So you have to understand what those rules are. One of the major rules in distribution is you don't want to run out of money before you run out of life. Another rule is that it's no longer about the accumulation rate, but it is all about the distribution rate. Another rule is how you want to make certain that the vast majority of your assets are tax-free. Another rule would be that you also want the vast majority of your assets to be fully protected from stock market volatility and interest rate volatility and so forth. So those are things that are very critically important when it comes to retirement planning. Now, you may wonder why, if this podcast is called To Roth or Not to Roth, tax is a question. Why are we talking about these things? Well, because they all play a major role in your retirement distribution. So obviously, I want to give you a base, a foundation, and then we'll talk a little bit about, what's better, to Roth or not to Roth, and what are the issues and considerations that you need to take into account in order to make certain that you make the right decision at the right time and for the right reason. A couple of things on the U.S. tax code, and these are realities that are important for all of us to know, is that, Social Security is having a major challenge in our country. For many of us who are already in our 50s and 60s, we may not have much to worry about. But the younger generations are going to have to deal with a big hot potato, and no one is actually engaging in that process. Nobody wants to talk about the hot potato, how to take care of Social Security and Medicare, and the underfunding and the unfunded liabilities out of these plans. But just to give you a little bit of feedback, when you take a look at Social Security all by itself, back in 1935, the ratio of retirees to people employed was 42-1. That means that for every person that was retired in the United States back in 1935, there were 42 people working. Now, today the ratio is 3-1. So we've gone from 42-1 to 3-1. One of the major reasons for that is that the U.S. population is getting older. The baby boom generation, depending on which publication you read, those of us who were born between 1946 and 1964, There are north of 74 million of us. And we're all getting old pretty quick. But the most important part of that is we're actually living a lot longer today than we did back then. So that's one of the main reasons why we only have 3 Americans working for every person that's retired. And what's really sad is that by the year 2026, which is not too far, it's actually 7 years from now, the ratio will be a 2-to-1 ratio. So for every 2 Americans that are working, there's one that's retired. Always remember that our Social Security is a pay-as-you-go system. So those of us that are working today are paying for those that are retired. So that's something that you need to keep in mind, especially as you start to figure out, whether to make your contributions to a Roth or to a traditional retirement account. Now, the main reason about whether to make a contribution to a Roth or to a traditional retirement account is nothing more, nothing less than taxation. Where do you think that taxes are going to be in the future? Do you think that taxes are going to be a lot higher in the future than they are today? Do you think that your personal taxes are going to be higher in the future than they are today? So we'll talk a little bit about that along those lines. But just to give you a little bit of flavor as to how to understand qualified plans, and I'm talking about your traditional 401ks, IRAs, your 403bs, your SEPs, and so forth, I think it's important to have a base knowledge of how these plans work in order for you to have more ammunition at the point in time that you're going to start making decisions whether to Roth or not to Roth. So sticking to the understanding qualified plans, and I'm only talking about traditional ones, again, 401ks, IRAs, and so forth, taxes are not really saved. They're actually postponed. And or borrowed. In other words, if you have the ability to put $10,000 into a 401k in 2019, when you put those $10,000 at a 30% tax bracket, you're actually taking a deduction on those contributions today. But in reality, what belongs to the IRS will always belong to the IRS. So out of the $10,000 that you put into your pre-tax qualified plan, let's say a 401k, if you're in the 30% tax bracket, $3,000 of those $10,000 actually belong to the IRS. So the IRS is basically allowing you to use their money for a number of years in order to for them to benefit as well. And you will notice, based on the podcast that we did last year, not last year, but last week, dealing with the retirement distributions and the challenges with that, you would notice that the vast majority of Americans will end up paying more in taxes than all the savings, quote-unquote savings that they incurred when they were putting money away in their 401k. So at the end of the day, taxes are not saved, so don't believe your accountant and your tax preparer. You're not saving taxes, you're postponing the taxes. Not only that, when you postpone the tax, you also postpone the tax liability. The other issue is that qualified plans are controlled by the IRS code, and they can make changes at any point in time. There are going to be some big changes, more than likely coming in 2020, as a fact that most of it has already been approved by the House and the Senate, so it may be coming upon us very, very soon. Qualified plans also have distribution penalty rules. 59.5 and 70.5. So if you pull money out prior to age 59.5, then you could have a premature distribution penalty of 10%. If you don't pull money out starting at age 70.5, then you're going to have an excise tax penalty of required minimum distributions, which will give you a 50% tax penalty on those monies that you were supposed to pull at 70.5, but you failed to do so. So in reality, you only have 11-year window between 59.5 and 70.5 in order to do whatever it is that you feel like doing with your retirement accounts. Before 59.5, you have penalties. Post 70.5, you also have penalties. Another issue with qualified plans is there are no deductions for investment losses. So when your 401k goes through a market crash, as it did in 2003 and 2008, and your 401k becomes a 201k, you cannot report those as losses because all the contributions have been made on a pre-tax basis, and you have no cost basis attached or assigned to those accounts. And obviously distributions are taxed as ordinary income. Another thing that you have to be aware of when it comes to the distribution portion of your qualified plans is that tax volume usually increases anywhere from 8 to 12 times during retirement. In other words, all those tax savings, quote unquote, that you thought that you had received when you were making those contributions on a pre-tax basis and not paying the IRS taxes on those monies, when you start taking the money out and you have to start paying taxes on every single dollar of distribution, there's a very high probability that you're going to end up paying the IRS 8 to 12 times more in taxes than all those pre-retirement savings that you thought you had incurred. Another big issue is lack of flexibility and distribution handcuffs, and we have already mentioned some of those things. If you happen to borrow from a 401k, the funds must be repaid within a 5-year period. But most important, the funds that you have actually borrowed. Now, you may say, well, Bert, I'm going to borrow money, I'm going to pay it back to myself, and the interest rate is going back into my account. And yes, and that's well and good. But at the end of the day, the borrowed funds must be repaid not only within 5 years, but you also have to repay them with after-tax dollars through payroll deduction, and that creates a double taxation scenario in the future because now that you're putting that money back in with after-tax dollars, and then when you retire and start taking that money all over again, then you're going to have to pay taxes on that at that point in time one more time. So, those are things that you need to be aware of. Does it make sense to make contributions to a qualified plan? Absolutely. But there are guidelines, and I talked a little bit about this in last week's podcast when I talked about the name of the podcast, by the way, if you want to research it, is the one that's called No Good Deed Ever Goes Unpunished. And I did spend quite a bit of time talking about the distribution and the taxation of those distributions and the fact that, what you thought was a good deed, you were actually punished toward the very end upon distribution of those assets. Now, some of you may say, well, Bert, perhaps I shouldn't be making contributions to my Roth because I'm going to be in a lower tax bracket in retirement. I can tell you from personal experience and the fact that I've been dealing with many, many clients for many, many years, actually 30 years, is that the only way you're going to be in a lower tax bracket in retirement is if you have been a financial failure for your entire life. Because one of the main reasons is that, a lot of the stuff, a lot of the deductions and credits that you're getting today while you're employed, you're actually going to lose in retirement. So, for instance, if you retire and your mortgage is paid for, well, you're not going to have that mortgage deduction. Some of you, the mortgage may not be paid for, but you have been making mortgage payments for many, many years. So, toward the end of your mortgage life, the vast majority of your payments are going toward principal because interest is usually front-end loaded when it comes to mortgages. So, therefore, the deduction for the interest is going to be very minimal. So, you're going to lose your mortgage interest deduction. You're going to lose your children. Now, your children may still be living at home with you, but you can't deduct them anymore. So you're not going to have those deductions for your children. That not only would they be a deduction, but they would also be a credit. Obviously, because of the fact that you're already retired, you're no longer making contributions to your 401ks, IRAs, 403bs, so you're not taking those deductions in the year that you make those contributions. And then last but not least, you're probably not making a lot of contributions to your favorite charities because, what I have found out is that for people that are very charitable in nature, once they retire, they start shifting. and they start giving more of their time as opposed to more of their money, because now they have limited resources in retirement that have to last time. So even if taxes were not to go up in the future, which we all know that that's not going to be the case, just the fact that you're losing a lot of those deductions and credits may actually force your taxes to be higher in the future than they are today. Now, another question that I get often is, what are some of the federal income tax free sources? So where are some of the sources that we can invest money in which we can get a tax-free return or distribution of those assets? Well, in reality, there are four. And number one, you have your Roth IRAs, which we'll talk a little bit more about, your Roth 401ks, you have your municipal bonds, and then last but not least, your 7702 plans, which are cash value life insurance plans, and many of my friends call 7702 plans the Roth IRAs on steroids, because of all the features and benefits that 7702 plans and the flexibilities that no other investment plan or retirement plan in the United States brings forth to the table. Now, I do have an asterisk on municipal bonds. Although they're received federal income tax-free, the income that you do receive from municipal bonds do play a negative, does have a negative effect on your taxation of your Social Security benefits, and we'll touch upon that in the next few minutes as well. But when it comes to totally exempt vehicles under the IRS code, from a taxation standpoint, we would only be looking at Roth IRAs, Roth 401ks, and 7702 plans, and those three are very, very powerful from a business perspective. So now let's talk a little bit about Roth IRAs and Roth 401ks. Why are they so good? What's the good, the bad, and the ugly regarding these accounts? Well, for those of you that may not know about this, these accounts haven't been around for too long. As a matter of fact, if you work for an employer, there are still employers out there that do not offer a Roth 401k option. If you work for an employer and you do have the option to invest into a Roth 401k, obviously you have to do some tax planning and due diligence. If you don't know, please feel free to reach out to me and I'll help you along those lines to determine whether 100% of your money should go to a traditional 401k versus a Roth, or a combination of the two, and that all has to do with tax planning. But let's get a little bit more into traditional Roth accounts. And here I'm going to lump sum your IRAs and your 401ks, whether it's a Roth IRA or a Roth 401k. Number one, there's tax-free growth of accumulated funds. So once you put the money in there, the money will grow tax-free for the rest of your life. There is tax distribution of accumulated funds. So you can, when you retire, you can start pulling money out of those funds on a tax-free basis. Therefore, if taxes were to increase in the future, even if it is only by 1%, even if taxes don't increase, but your personal income taxes do increase by, 5 or 10% because of the fact that you have lost all of your deductions and credits that you enjoyed while you were employed, you would be better off having a Roth 401k or a Roth IRA because of the fact of the tax-free distribution. Now, obviously, there are some caveats. There's limited contribution amounts, both to a Roth 401k and Roth IRA, and those numbers change from one year to the next. There's no access to accumulated funds prior to age 59 and a half. So if you need to invade your Roth IRA accounts, your Roth 401ks prior to age 59 and a half, you would have to pay taxes and a penalty on the growth. But you can always get your principal without having to pay taxes, because that would be the principal of your investment. But for the most part, there's not a lot of flexibility prior to age 59 when it comes to your Roth IRAs and your Roth 401ks. Now, one of the major, and I repeat, major advantages of Roth IRAs is the fact that there's no required minimum distribution of accumulated funds at age 70 and a half. So you could have $500,000 in a Roth IRA at age 70 and a half. You now control the distribution. The IRS does not have any control of that distribution. Now, if you have your money, if you have that same $500,000 in a traditional IRA and or a traditional 401k and or a traditional 403b, then the IRS controls the distribution at 70 and a half, because whether you want to or not, whether you need the money or not, you're going to have to start taking distributions, or you're going to have to pay a very hefty penalty of 50% for not taking distributions. But if your money's in a Roth account, by the way, Roth 401ks do have a 70 and a half required minimum distribution. Obviously, when a lot of my clients get to that stage where they hit age 70, right before they hit age 70 and a half, what we do is we do a rollover, and we transfer the Roth 401k to a Roth IRA in order to avoid the minimum required distribution at age 70 and a half. Another big advantage of Roth accounts, whether it's a Roth IRA or Roth 401k, is that they have no negative impact, and they create no Social Security tax triggers under the provisional income calculation. And then obviously these accounts are creditor protected. Now, municipal bonds, again, there's tax-free growth of the accumulated assets. There's tax-free distribution of accumulated funds in your residential state. So you have to be careful. If you live in Florida, you buy a bond in Florida, you were not going to pay any federal income taxes. And if Florida would have had state income tax, then you wouldn't pay state income tax, because you actually purchase a bond in the state. But if you live in a state where there's a state income tax and you purchase a bond outside of that state, you're not going to pay federal income taxes, but you may very well have to pay a state income tax. And if you happen to own a municipal bond fund, although the income that you generate is federal income tax free, if you do sell the fund and there's a capital gain in that fund, then obviously you're going to owe taxes on those distributions. So be aware that muni bonds are good, but you also have to be careful with them from a business standpoint. Now, obviously, there's no required minimum distributions at age 70 and a half out of municipal bonds, and they do in fact create a Social Security tax trigger based on the provisional income calculation, which we'll talk about in the next few minutes. And there is no credit protection in municipal bond funds as there is in Roth IRAs and Roth 401ks. Now, last but not least, let's talk a little bit about 7702 plans. Again, these are cash value life insurance plans. This is like a Roth on steroids. Obviously, it's not a Roth account. It is a life insurance contract, but it has tremendous features and benefits that if you know how to use them, you can truly maximize your internal rate of return. If you want to truly enjoy a tax-free retirement life, you cannot do it just by having a Roth IRA or a Roth 401k or a 7702 plan. My experience and all the audits that I have done for my clients is that if you want to have a tax-free retirement life, it requires you to have all three. You need to have Roth IRAs, Roth 401ks, and 7702 plans along those lines. Now, 7702 plans, there's a tax-free death benefit, so it does have a death benefit attached to it. There's also tax-free growth of accumulated funds. They grow on a tax-deferred basis. There's tax-free distribution of the accumulated funds. As long as you do it the right way, you can pull money out of life insurance contracts on a tax-preferred basis. There's tax-free transfer of those funds at death, with proper structure, with no federal income taxes and or estate taxes, depending on the size and the value of your estate. For most of us, it's not going to be applicable anyways. You do have access to your funds, to the growth of those funds prior to age 59 and a half, and that's contrary to your Roth IRAs and your Roth 401ks, but is very similar to municipal bond funds. So you do have the ability to pull money out of your 7702 plans prior to age 59 and a half. And if you do it the right way, you do it without paying taxes and without paying any type of penalties. And just like in a traditional Roth IRA, there are no required minimum distributions of accumulated funds at 70 and a half. One of the best features that I use with my clients often is we try to maximize the contributions to Roth IRAs, and then on top of that, we maximize contributions to 7702 plans because of the fact that since we don't have a minimum required distribution at age 70 and a half, we can allow those funds to continue to grow on a tax-free basis, tax-deferred basis for many years later after age 70 and a half. So perhaps if you have money in your IRAs and your traditional 401ks, when you get to 70 and a half, you start taking distribution out of those plans, and then you allow your Roth IRAs and your 7702 plans to continue to grow tax-free because you have total tax control and you have distribution control. Obviously, the fact that you're not paying taxes, it gives you the control, and on top of that, you don't have to have distribution. So you can say, I'm going to start taking money out of these 7702 and Roth IRA plans once I hit my mid-70s or my late 70s or early 80s. You get to make that decision not only on a goals basis but also on a needs basis as well. So that's important. 7702 plans, they're creditor protected in Florida. You got to check with each and every one of your states. Some provide more credit protection than others. I know in Florida we do enjoy quite a bit of creditor protection when it comes to 7702 plans. One of the beauties of 7702 plans is that they're self-completed in case of death or disability. So you start putting money away in a 7702 plan in order to maximize your retirement distribution planning. What if you happen to have a premature death and you don't make it to retirement? What if you die all of a sudden? Then the death benefit would actually replace that income and that growth that you never had a chance to put away, and at least your family is going to be taken care of. Many of these new plans now, especially if you do it the right way, they provide long-term care benefits. So that's another major feature, because living with a disability is one of the major issues that most of us are going to have to deal with in the future because of the fact that we're living so much longer than ever before. These plans also provide competitive rates of returns and guarantees, indexes, so you can, there's just like Baskin Robbins, there are 31 different flavors that you can use and so forth. And one of the major advantages of 7702 plans, just like in your Roth IRAs and your Roth 401ks, is that they do not trigger any negative taxation of your Social Security benefit. So whenever I engage a client and they're interested in maximizing their Roth contributions and 7702 plans, what I basically tell them is that the insurance companies determine the minimum premium, the IRS determines the maximum premium, and then Gables, which is my firm, and our clients, we actually determine the optimum premium based on the goals and objectives of the clients that we're engaging. So for those of you that are thinking about making these contributions, make sure that you talk to your advisor, make sure you talk to your accountant to make certain that you understand what the potential benefits would be and what would be the amounts that you should be contributing. Also remember that your required minimum distribution, so you have to go back to the previous year. If you turn 70 and a half in 2019, as I covered in last week's podcast, you're going to have to take the account values of those accounts as of 12/31/2018. If you turn 70 and a half in 2019, and you're going to have to secure a minimum distribution rate that we talked about last week. So you have to be very careful, because if you don't do your due diligence here, then there's a high probability that you're going to be able, or you're going to have to pay an excise tax that could be 50%. And on top of that, you're going to have to pay the taxes on that distribution that you should have taken that you didn't. Also bear in mind that one of the major reasons why I highly recommend Roth IRAs, Roth 401ks, excuse me, and 7702 plans for my clients is that they don't play a role in your Social Security taxation. One of the major problems that we have with Americans is that the vast majority of them, their Social Security benefits are going to be taxed, and they're going to be taxed at either 50% or 85%, and that's a major, major problem, because if your Social Security benefits are taxed, then statistically speaking, you will run out of money 5 to 8 years sooner than expected, because if you have to pay taxes on your Social Security benefits, you're going to have to fill that hole, and the only way you're going to be able to fill it is by continuing to take money of your other retirement accounts in order to mitigate that gap that you're going to find yourself in. If you're single, when you do your provisional income calculation, if your total income at the time that you do your tax filing for the year is less than $25,000, then you pay no taxes on your Social Security benefits. If it's between $25,000 and $34,000, up to 50% of your Social Security benefits will be taxable, and anything over $34,000, if you're single, up to 85% of your Social Security benefits will come into the tax table for taxation. If you're married, filing jointly, and your income, your provisional income is less than $32,000, then you pay no taxes whatsoever on your Social Security benefits. If it is between $32,000 and $44,000, up to 50% will be taxable, and any income that exceeds $44,000, up to 85% of your Social Security benefits will come into play. Now, the big question is, well, what does it entail when you talk about provisional income calculations, Bert? And basically, that provisional income calculation is a calculation that must be performed every single year once you start retirement, which will determine what percentage of your Social Security benefits will be taxable. And the way that we do the calculations, and I do these every year for my clients, is you take 50% of that Social Security benefit. To that, we're going to add ordinary income. That would include if you have any part-time job or full-time job. Any distributions, let me repeat that again, any distributions that you take from your traditional IRAs and your traditional 401ks and your traditional 403bs, or any traditional pension benefits that you receive, will be added on to the calculation. To that, we're going to have to add your capital gains and dividend distributions for the year, and then last but not least, any income received from non-taxable sources like your municipal bond funds. Notice that I never mention Roth IRAs, Roth 401ks, or 7702 plans. And the reason why I didn't mention it is because it's not factored into your provisional income calculation. So even if you have $200,000 of income on any given year, and that income comes from, let's say 100% of your income in retirement comes from Roth IRAs, Roth 401ks, and 7702 plans, guess what? You pay no taxes on your Roth IRAs, no taxes on your Roth 401ks, no taxes on your 7702 plans, no taxes on your Social Security benefits. Your Medicare premium will remain at the lowest level. And most important, you may even actually qualify for Medicaid and food stamps, because none of those items are reportable under the IRS code. So if you're really trying to figure out whether it makes sense to put money away in a Roth or not, or whether to Roth or not, and again, tax is a question, then I behoove you to take a look at it very closely, because most of you should be maximizing your contributions, especially the type of clients that I deal with, should be maximizing your contributions to your Roth IRAs, Roth 401ks, and 7702 plans. Now, what if you already have a lot of money in IRAs and 401ks? What if you're already, let's say, 60 years of age, and you're going to be retiring in the next 5 to 10 years, depending on your age? What can you do? Does that mean that you can't get out of that hole anymore because all that money happens to be sitting in qualified plans that are now forever taxed? Well, the answer is no. Again, under the new tax law, we only have a 7-year window, so you need to be able to do tax planning every year. And if you do tax planning every year and you do it properly, there's something called Roth Conversions. That means that you can start converting a portion of your traditional IRAs to a Roth IRA every single year. And if you do so for at least the next 7 years, you're going to be able to minimize your tax liabilities because since the Tax Cuts and Jobs Act is going to sunset December 31st, 2025, we all know that January 1, 2026, taxes are going to be a lot higher than they are today. So you have a 7-year window, and if you do proper tax planning, I can help you determine what percentage of those IRAs can be converted to a Roth, because taxes, the ticket to get into a Roth world is to be able to pay the tax today. But if your tax liability is going to be greater in the future than they are today, the compounding effect of you taking that contribution and paying that tax today is going to be enormously beneficial to you in the future. Not only that, the fact that now when that money goes into the Roth IRA, you control distribution 100%, and you don't have to take the money out if you don't want to. And it would go tax-free to your beneficiaries. Or if you need to take the money out at some point in time in the future, you can determine when to pull that trigger, because you don't have to do it at age 70 and a half. Now, the longer those assets are growing on a tax-free basis, the more you're offsetting those taxes that you pay today in order to buy the ticket to get you into the Roth and the 7702 plan game. So those are the things that I think are important. Hopefully this podcast is giving you some food for thought. Always remember that my number one goal is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. And most important, if you want to schedule a 20 to a 30-minute conference call with me, or a video conference at no cost or obligation, please feel free to do so. You can reach out to me at area code 786-766-1042, or you can email me at Bert, B-E-R-T, at gablestaxgroup.com. Hope you have enjoyed this podcast. I look forward to seeing you again next week, and we'll talk again soon. Take care. Bye-bye.